Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and I have one of my very favorite people and the best person for real estate that there is in the country, with Ivy Zelman. Ivy is founder of Zelman Associates. Ivy, you have too many accolades. I can't even get into them all, so I'm not going to go that direction, but I would recommend everybody to read your book if they get a chance. But welcome. I'm glad to have you, Ivy.
Well, thanks for having me. I'd like to take you on the road with me, Ted, given all the accolades. So appreciate it. Great to be back.
Well, you've got a lot of them, that's for sure. And you're well deserved. If you read your book, you'll know you did it the hard way.
Thank
Hey, let's start talking about, I was interested in the graph you had about, I think most people are probably not aware of population household growth trends declining, but
Yes.
you've got a good graph on that.
Sure. I think that the three components that drive household growth really, you think about population sort of feeds household growth. So if you go, what drives population? It's deaths, immigration, and births. And those have all been going the wrong way for quite some time now. And while deaths accelerated, due to COVID, the expectation is over the next several decades, it's only going to accelerate unless we have a change in immigration. Regulatory changes around immigration, that's not looking optimistic. And of course, birth rates have been remaining at very low levels. So household growth is expected by the end of this decade to slow to about 4%, where it had been growing at almost 8%. So I think we're poised for a deceleration in households. And that's also not really factoring in any type of recession that can cause doubling up and household sort of multi-family or multi-generational living that's could accelerate in a more depressed economic backdrop.
Well, speaking of that, and I know most of the people watching this that, like myself, that own parts of community banks are obviously watch our spec builders quite a bit. And you've got it looks like in your graphs on that the spec inventory is gone back up.
Yeah, the specs, strategically, builders realize that consumers are preferring move-in ready homes. And so after the initial decline that we saw in 22, that was short-lived. After 6 months and the first half of 22, we started to see stabilization, and they had really pulled back on starting specs. And we did see backlog of specs declining. But once the market started resuming and surprising everyone in the first half of 23 with a very strong spring selling season, the builders put their foot on the gas and they're starting and accelerating specs. And that's really a question of, what they're going to have to do to move that inventory. And I think right now we're seeing them focused on absorptions over price, and they will do what they have to move that inventory.
And Ivy, you're looking at who's buying those specs or buying those existing homes even. You've got a great graph on the monthly payment. I guess my question to you is, you've got that up around $3,000 a month. I mean, isn't there a choking point here somewhere?
I think we're there. I think the affordability is definitely challenged. And I think what you're seeing are, consumers today that are benefiting from, whether it be dual income, combination of family support, whether wealth transfer. We used to see people provide wealth transfer when they died in estate planning. Now parents are helping kids during, while they're still around. And so you're seeing a lot of support from family. And again, that wealth transfer, I think you're also getting advantages because builders are providing mortgage rate buydowns for 30 years, and they can be providing someone a 5% mortgage rate, even if mortgage rates are at, let's say, 7.5 plus. So that provides a mitigation of the challenges from the affordability issue. But no question, there's a sentiment in the market that more and more buyers are finding it very challenging. And I think we're going to see that continue unless rates come down and higher for longer. If that's the future, I think that we're going to see that part of the market slow further.
And Ivy, don't you think right after this explosive growth in the price is when they set the valuations on taxes? So we got taxes and we got insurance, and that's not on top of what you're showing, I don't think.
No, actually, you bring up a good point, because I do think that there are many headwinds for the consumers, and especially in those southern coastal markets where homeowners insurance is very challenging right now. We're seeing exponential increases in homeowners insurance and utilities and property taxes. So the wallet's getting squeezed on non-discretionary purchases or non-discretionary expenses. I guess one aspect that we have to really contemplate as to why the first-time buyer market has been holding up, let's put it in perspective. We are currently at the lowest level of existing home sales from a volume perspective, even lower than where we averaged from the great financial crisis. So we just saw the September existing home close numbers, or existing home closings were 3.96 million. And that, of course, is a monthly annualized number. But just to put that perspective, that's lower than the average of the great financial crisis. And when you therefore layer on new home, if you're really just seeing a share shift, so I'd say the market's pretty weak overall. The new home market is taking share because of the competitive advantage, again, of buying rate downs and other, I think, offerings in terms of incentives. And I do think the economy is still strong. So we do have job growth, despite the fact that, Jay Powell is trying to break the economy. We still have strong job growth. We still have wage inflation. And those variables are assumingly what is the underpinnings of why we continue to see demand in the face of higher rates.
And in talking about those starts, if you look at it, Ivy, you have a bill for rent chart that's really good, and I was interested in seeing that there's still a big piece of the of the starts.
Yeah, it's a lot of those starts are developments that were purchased and let's say financed like a year or 2 years ago, that had already sewers and pipes and already dug in terms of the moving forward. I don't expect to see that number accelerate. We would anticipate you'll see deceleration. It's just not penciling now. We're seeing build for rent developers that are trying to sell a lot of communities to builders for the for sale market because of the challenges with higher cost debt. So we see that market right now under a lot of pressure, but don't expect it to go away. So when we speak to our builders that actually sell inventory directly to build for rent operators, they're still selling some, but very negligible amount relative to what it had been. So that market is under pressure and definitely due to the higher rate, higher cost environment.
And it's interesting, Ivy. I mean, we have knowledge, I should say, of a couple of investors that have put quite a bit of money in build for rent. But those GPs have come back and asked them for a cash call. So I can tell that they've got pressure on the marketplace.
Interesting. Yeah. Not surprising. I mean, look at how they underwrote those at what valuation and where the cost of debt, they didn't obviously had much lower financing. So I don't know how they can pencil the returns that they promised their investors.
So Ivy, you have a slide where you talk about looking at single family for rent and for sale, and you say that you should be looking at the total. Explain why that is.
Well, I think there's a lot of emphasis on the fact that inventory is at the most depressed levels in decades, which existing home inventory is at very depressed levels. But what people need to appreciate is if you look including what's for sale on top of what's available for rent, that actually is the right way to consider it, because shelter is shelter. So rental competes with for sale, especially when we're looking at single family, which is apples to apples. So if consumers today really can't afford to buy a home, they're going to opt to rent. So if we're seeing a lot more rental product on the market, it could actually benefit rental operators by taking the share that would otherwise be depleted or, basically absorbed by the for sale market.
So when you're focusing on, you mentioned to this about focusing on the balance and not the flow up. Explain what you mean by that.
Sure. I think that when people look at absolute levels of inventory and their expectation is that because of the constrained supply in the housing market, that's going to allow the builders to continue to seek growth because they have product offering and the existing market doesn't. They're taking an absolute look, but it's really about the incremental new listings coming to market. And therefore, it's the rate of change that will really drive the future growth for the builders. So if we're seeing the number of incremental listings coming to market increasing, that will impact the rate of change for absorptions from the builders. Don't look at absolutes, look at rate of change. And I think that will give you a better picture of what the future will look like for both new construction as well as the existing housing market. The CEO of Redfin, who just reported earnings, was talking about they're starting to see a pickup in listings. And as we know, with more supply hitting the market, we're going to see price pressure. because in order to move that inventory that people have to move, in real estate, there's the 3Ds: death, divorce, default. So we always have transactions. We're running at about 3% of households. Again, that's sort of a trough level where we've seen in prior recessions, not only GFC, but back to 1991. And yet, you also have still that discretionary mover, that fourth D that's still there. So as more people are listing and say, what, screw it. I know I can't hold on to this low mortgage rate that I have. I need to move. That increasing listing pressure will start to have an impact on price. And we expect prices will sequentially start to be pressured as inventory is rising.
So if I shift, one of the things I see in talking to realtors is that the first time I've really noticed a lot is in the last 3 months where they said, hey, we just don't have any traffic. And the other thing I'm seeing in various cities is that the contractors, they used to be, hey, I can't get to you for a year or something. And you have a great graph on non-residential construction vertical, and all of those, I guess, except one, are negative. But it seems as though contractors they're going to have to hustle up here because business is not what it was.
Right. And this is on, non-residential new starts, so as opposed to non-residential maintenance. And so that, part of the market is pretty dismal in terms of the non-res starts. And I think education is the only one that's ticked higher. And this is coming from our survey respondents that are selling building materials, building products to that end market. So it's pretty weak out there. And you're right, they're going to have to hustle, and looking at various areas that have remained fairly robust. Multifamily has had robust starts, despite the fact that we're seeing a significant drop off in transactions and values are under pressure. That's helping those contractors today. In fact, one of my distributors just had opportunity to meet with them last Thursday. There are several billion in building materials and several other segments. They were like, oh, thank God for multifamily. I said, well, don't count on it too long, because that's a backlog that will get depleted and starts are going to plummet there because of the inability, again, to pencil out returns at today's values.
Well, and speaking of multifamily, you have a graph about the units in thousands, about starts and completions backlog. There's still, if you look at backlog, they're still high. And with the number one question we get, Ivy, is who's going to live in all these apartments? And maybe it's there. I don't know. We're asking you that question.
Well, there's this, mantra in the market. The narrative is that the housing market is severely undersupplied. We don't have enough housing, and there's a shortage, and estimates go from 3 million to 6 million from other demographers in the market. And our view is that we're more in balance. But in multifamily, we actually believe we're 30% over supplied. And so when we're seeing and hearing that the pressure in the market with blended rent growth decelerating substantially, new move-in rent growth negative, with a lot of these buildings, working hard to get occupants to fill up these buildings, my question is, why? Well, if we had a shortage, why is it so challenging to fill up these buildings?
Well, and you have a great slide on that about the normalized demand and what the demand is and what the supply is. And gosh, there's a big gap there.
What we could really see is it more pronounced in the Sun Belt. Everyone went to the Sun Belt, predominantly Southwest, Southeast, and the supply and backlog is more concentrated. That's going to be coming to completion. And that's a backlog that's massive. It's like the highest level still is back to the 70s. So the pressure we're seeing on lease rates right now is even without those completions coming to market yet. There's a lot more supply coming.
And, I don't know how that's financed, but one of the things we're seeing is that, you've got your investors in multifamily and what I call your flippers, they're turning them. And that group seems to be in the world of hurt. Yeah, a purchase and sale. But you also have a graph on the rent growth descent.
Yes.
How those are declining on the move-in, the renewal. And that's really declined.
Yeah, in fact, if we just published today our third quarter wrap up for the public REITs that reported over the last week or two, and it was actually worse than we had anticipated. The new move-in rent growth was up about, I think, 40 basis points. If you take out one player, it was up 10. And actually, the October data was negative overall, 2.5% to 3%. And they'll kind of try to make excuses, say, well, if you take out Seattle and if you take out San Francisco and if you take out this market, it doesn't look so bad. But I do think we're surprised at the level of deceleration and actually lowered our numbers for fourth quarter and for 2024 for further pressure where we were already pretty cautious.
Well, and you have a great slide on buyer demand and how it's really sinking right now.
Talking about on the transaction side,
on the transaction side.
I think it's a bit of a standoff. It's this great poker game, and the sellers are like, I don't need to sell, and the buyers are like, well, I don't need to buy at these values. I want a better value. And I think it's also about those buyers need to finance the deals, and so I think there's unfortunately less demand because there's just less financing. There's less debt financing, less equity financing, and the returns they can't justify it. So I think I call it a buyer strike. And they need better, inputs to pencil the returns that they need to provide to their investors.
Well, and it's interesting in shifting to banks and commercial real estate. You have a great graph on how the banks are exposed. I'm talking about small banks now,
right?
Exposed to the top three, if single builders, in commercial and multifamily. And I wonder sometimes how much of that is the keys may come back, I should say, because in the last 2 months, particularly on buildings and commercial buildings, I think I've seen one a week that either went back to the insurance company or went back to the bank. And we're starting to really see it a lot now.
I think the risk, honestly, Ted, you've got still an economic backdrop that's positive. I think that we could see a lot more keys coming back if we're in a recession. So as of right now, I think, our expectations is it could get worse. If you look at the large banks, overall commercial real estate is like less than 0.25% of their holdings. Multifamily is like 5%. But when you get to the small banks, they have a lot more exposure, in the 70% for some. And in terms of commercial real estate, multifamily, it's a very big part, including single family, their exposure. So I'd say it's going to be, challenging waters just to manage through and challenging times. But I do think there'll be a lot of workouts. They don't want those keys back. So what can we do to modify those loans, or if they're poised to refi, what can we do to keep these borrowers current?
And Ivy, it's interesting because I've seen the banking system go up and down, and you would have thought that it would have had a memory. But I saw so much in the last 7 or 8 years of non-recourse on all these deals like this. And I'm thinking all the while, so you have non-recourse. And so, what's not to stop that group from just handing it back to you?
Well, in some cases, there's a tremendous amount of equity in a lot of these deals. So I think that the banks could actually be okay. It depends on when the deal was underwritten. But, there was a very low LTV in a lot of the transactions. It used to be, I don't know, 65, 70% LTVs. I think that merchant builders started seeing a little bit more favorable terms. But I think that values are down, according to various sources on a national basis for at least multifamily, we're down in the mid-teens, maybe. I think some markets are down substantially, down 40%. So there goes that equity. So, there are markets that are more challenged than others, but nationally, if we see that cap rates have stopped expanding and values are going to stay where they are, I think we're okay. But my question is, why would values stay where they are if there's more supply coming and more pressure, assuming, again, we're still in a good economic backdrop?
And what we're seeing is the big companies that had the leases for certain periods of time, a lot of those people have gone home or gone to another state. And so when they're coming up, then they're ending up with a 25% or higher of that building empty, and nobody to go into it. And I think that's one of the problems. You've got a really good graph on how CRE is at the center of the banking turmoil. You've got about 25%, I think, on your graph of commercial real estate.
Right.
Well, that's a big piece.
Right. And again, the equity piece is the important, I think, buffer. And I think that the banks are working with their borrowers to possibly modify them if necessary, but they do have a lot of cushion right now. And it also depends on the geographies of how much of their holdings are in the markets that are more plagued with supply. So I don't think we can draw a line across, the entire market and say we're going to have, a lot more just, delinquencies or defaults completely and keys coming back. But I think there'll be pockets of markets, especially for the newer entrants, those merchant builders that haven't really been through downturns before, and their terms of their overall deals were a lot more let's say loosely financed, not as stringent.
Yeah. So I'm going to shift it here at the end to some of your forecasts, and the first one is the housing forecast where you show completions and housing starts, new home price appreciation, and you show what you're showing through 25. That new orders, completions are about flat. It looks that way to me. Am I reading it right?
Yeah, I think right now what we see is a lot of the single family side of the equation. Today, public companies account for more than 50% of the new home market. So those public companies are sitting on land supply that could be anywhere from as little as 2 to 3 years to as much as, approaching 7, 8 years. And they are going to move through those land holdings. They are going to start homes. They're machines, and they're going to build homes and they're going to sell them. So the volume side, I can easily feel comfortable with on a, looking out this year and next year, that they're going to keep bringing inventory to market. The real question mark is what will the price of those units be? So where the lever to the downside would be is price. And right now, without being an economist and having, I might have my personal opinion on the outlook for the economy, but I'm not an economist to predict the economy. But we're kind of assuming a status quo, and our inclination is more negative, but we're not, economists to call, are we going to be in a recession in 24 or 25? And given that, I think price will be likely under pressure relative to our forecast is where we think the downside is. Like, for example, in existing homes, we're forecasting a flat or down 1 in 24 and up 7 in 25. Well, why would you be up 7 in 25? It's likely because you're going to see the beginnings of recovery, and you'll probably see, if you're in a recession, that will be wrong there. But we're at such a low level. I already highlighted we're at kind of the trough levels of existing home sales. I do think that there'll be more volume because we could have more defaults as well that could drive volume.
Well, and the other thing I wanted to ask you, Ivy, talking about a recession, if you have a couple of down quarters, pretty good down quarters, 2 or 3, and you get in a situation where unemployment really rises, and a lot of these homes now have 2-earner families. So if you have one earner that loses the job, then don't you think that in itself will create some supply?
Yeah, I think we have a whole new ballgame if we have a recession. There's, no question there'll be a lot more risk to the housing market, because that's what's been really the driver of the sustainability that we've seen. I do think today, again, if you look at, FHA, there's really not much equity, 3%. If you got a VA loan, you've got no down payment, so you have no equity. You start looking at Fannie Freddie, you've got probably a 10% down payment. So there's not as much equity on the single family side. I think overall banks are a little bit more conservative on jumbo. They're looking at for a 20% down payment. So really question is, how much do we think home prices could be under pressure? And I think, again, it goes back to where there's a more concentration of supply. If the supply and the builders are putting their foot on the gas and they're trying to move that inventory, we saw in 22 net pricing, including incentives, was down 15, 20% in 22 pretty quickly. And that was really reflective of a market that materially slowed as rates spiked, and then found a place, to call it a base that they then started to lift off of. But they were also, again, that quick downturn, I think, was really attributed to a spike in rates that really was undermining confidence. And consumers are really fearful that, hey, we're back in GFC where home prices could go down, and we don't want to be the last person buying a house at these levels. But it turns out that we're not in a downturn. The economy remained resilient. But if you now go fast forward, and now you have an economy that's under pressure, and people, like you said, are losing jobs, I think you're going to see home prices could fall more dramatically from really the builders putting their foot on their gas to move that inventory as they did in 22.
And the last thing on your forecast is obviously in multifamily, and you're showing obviously starts declining in 24 and 25. But the one thing that I noticed on that is the upper right-hand piece where you show revenue takes a pretty good hit in 04 and 05, 24 and 25.
And those numbers arguably, Ted, right now, I think are going to be lower. We update our forecast because we're seeing rent pressure accelerating faster than anticipated, again, without a economic downturn. So that's really all supply driven for the most part. And the competitive pressures, will they intensify if we have less incremental households, or again, households doubling up and roommates doubling up? It's going to be likely that rents could go down further than what we're currently forecasting, is our expectation based on what we're seeing right now in a good economy if we have a recession.
And on the builder stocks, I noticed after Powell came out Wednesday, we had everybody jump in over 3 or 4 days and just really drive them hard. But don't you think it's a bit early on those building stocks to get real excited?
We do. I think, the builders, the large cap builders, especially builders like D.R. Horton and Lennar, who are price leaders, they account for 30% of the market, new home overall. And whatever they dictate, and they are machines, they will move inventory, will determine price. And we know that the market is challenged today with affordability. So if we have any type of economic weaknesses, which is what Jay Powell is trying to do, and the long end of the curve is helping him with, supply challenges there, I think we're going to see that, we're going to have weaker than seasonal trends heading into the end of the year, and the spring selling season could actually be more challenged, which I think, therefore, I would be more cautious about loading up on the builder stocks right now. Might take 1 or 2 that are really, in our opinion, the best executors, but I think you have to think about it beyond, a 6-month, 12-month time frame to hold them.
So one last thing I might ask you, if in looking at, the big picture, and if I'm a young person, I haven't bought any homes yet, okay? Would you, and let me add this too, in my whole time in the business, I've never had so many investors buy full cash out homes for their children as I've seen the last 3 or 4 years. I mean, it happens all the time, but let's say for people that don't have that kind of, the young person wants to look at a house, would you wait, or would you try to work something out? I'm just curious.
It's really somewhat case dependent. I have friends that ask me all the time because they know what I do for a living, and it depends on what the situation may be. So one example is a young 30-plus-year-old friend who's got kids, wants to move out to a more rural area, and they're pretty secure in their job, and the monthly payment, even though rates have gone up, will be even slightly down. So that might be, and that's where they want to live. So, if you want to move because it's your lifestyle and your family's bigger, and that's what you want, then go for it. If you're thinking about moving and you're worried about, the job situation might not be that great for one of the, say the households, and you're also going to be paying more for the new house because the monthly payment's going to be higher, I'd probably be more cautious and wait. So unless you have to move because it's need-based, and unfortunately, like I mentioned, our 3Ds, I would be more cautious to be incrementally buying right now. And I didn't talk about, Ted, one of the things that I think we need to be really thoughtful about is some of the challenge that we're going to be seeing from regulators from climate change. We're going to see a lot more pressure in markets that are more prone to risk from climate change, whether it be flooding, excessive heat, fires, and those costs around those markets are going to increase, and the risk of surprises are going to make it more difficult for consumers in those markets to not be exposed. So, our view would be that if you're in those markets, it might be to recontemplate or contemplate, maybe, do I want to still be in those markets given the higher cost of living there?
Well, I have to close with this. We visited a year ago, almost to the week, and most of what you said last year came to pass. So I'm sort of counting on you.
I can't remember, but I'm glad to hear that.
So I'm counting on you having another good look at this next 12 months. But as always, you're the best around, and I appreciate your time. I know people enjoy listening to you this time, so I appreciate you being here, Ivy, and we'll try to see you next year, we hope, okay?
Well, happy holidays to everyone. I can't believe it's almost that time of year again, but appreciate being on the show, and we'll look forward to next year.
All right, thanks.
Thank you.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.